How do high yield bonds stack up against investment grade bonds? Let's find out. Having a closer look at bonds as an asset class, we can see generally that there are three main important factors: credit quality, maturity, and yield. I performed a study on bond funds to help us understand how this works. At the beginning of this study, I had the following hypothesis. Lower credit grade high yield bonds are more insulated from market and interest rate risk and can serve as a safe parking place for funds because they are further away from the IG credit market in terms of yield spread. To test this hypothesis, I used the following methodology. A large list of bond funds was located to provide candidate funds for the study. This list of bond funds was composed of hundreds of funds with different credit quality, maturity, and size. There were links to the prospectus for each fund and other market data for each fund. The study was composed of bond funds from this list. A total of 57 bond funds were selected as representative candidates for the study, and information regarding the maturity distribution and credit quality of each fund was gathered from the official prospectus of each fund. This data was compiled into a table that provides the maturity structure and credit quality distribution of each fund. An aggregate figure for maturity and credit quality for each fund was produced from these distributions so that each fund could be assigned a maturity and credit quality as if it were a single issue. The observation period begins at the start of the last rate hike cycle on September 21st, 2021, and ends on January 1st, 2025. 10 funds were selected from the table by credit quality centered around a credit rating of A-, 0.76 in table scale, as representative of constant credit quality independent of maturity and yield. The minimum credit quality was 0.75 and the maximum was 0.76. This group is called constant quality and allows observation of behavior when credit quality is held in a tight range. Each fund was plotted in pane 1 and normalized to September 21st, 2021. Each fund was then color-coded in shades of blue, with darker blues representing longer maturity and lighter blues representing shorter maturity. The distribution of these funds' behavior over the rate hike observation period was then observed. 10 funds were then selected from the table by maturity, such that the high yield segment was included in the selection with other candidates as close to the same maturity as possible. The shortest maturity was 4.09 years and the longest was 4.83 years, giving a tight range of maturity for the group centered around 4.46 years. This group is called constant maturity and allows observation of behavior when maturity is held in a tight range. Each fund was plotted in pane 2 and normalized to September 21st, 2021. Each fund was then color-coded in shades of red, with darker reds representing higher credit grade and lighter reds representing lower credit grades. The distribution of these funds' behavior over the rate hike observation period was then observed. For added context and comparison, a full rate ribbon containing all U.S. bond yields color-coded by maturity and with prime rate and inflation included was plotted in pane 3. Bond prices for short bonds were plotted in pane 4, and bond prices for long bonds were plotted in pane 5. From all of the foregoing information, we can make the following observations. The ordering of the constant quality group at the end of the observation period is virtually identical to the ordering by maturity duration. This implies that for bonds of the same credit rating in the constant quality group, shorter duration bonds are less sensitive to changes in the prime rate and will lose less value during the course of a rate hike cycle. Long bonds are more sensitive to changes in prime rate and will lose significant value from face value during a rate hike cycle. The ordering of the constant maturity group at the end of the observation period is mixed, but with lower credit grades performing worse. This implies that for bonds of similar maturity duration in the constant maturity group, the effective credit grade appears to be much smaller than maturity duration in determining the reactivity of a bond fund to changes in interest rates. The effect of lower credit quality on the price performance of a bond fund appears to slightly increase the drawdown relative to higher credit quality during a rate hike cycle. However, the yields on lower quality bonds are significantly more. Triple C bond yields, XCCC 11.6%, are triple that of A minus bonds of similar maturity, SPIB 3.74%. However, the drawdown is only slightly 5% greater, 16% for XCCC versus 11% for SPIB. However, these drawdowns are still large compared to the shortest maturity bonds, 3.8% for SQLD. Another observation regarding high yield bonds is that they are almost entirely limited to maturity below 5 years. From all of this, we can draw the following conclusions. Assuming that fund diversification and due diligence is performed, it appears that high yield bonds can be a better choice compared to investment grade bonds of the same maturity. However, for providing safe harbor during a rate hike cycle, cash and cash equivalents, shortest maturity, highest credit grade bonds, are the best possible choice for capital preservation. High yield corporate debt is more properly viewed as one possible source of uncorrelated, liquid, and low maintenance income in a diversified income portfolio. Strictly speaking, it is not a safe harbor asset and should not be used as such. Long bonds are shown to be the worst possible choice in this asset class for protecting against drawdowns from a rate hike cycle. The original hypothesis is shown to be false in the sense that it assumes an inappropriate use case for the asset in question. Possible problems with the study include 1. There were not enough high yield bond funds at different maturities for a fully valid comparison with IG bonds of similar maturity. 2. More generally, there were very few high yield bond funds with credit grade below BB, making investigation more difficult. 3. Some of the most important funds of interest were started following the beginning of the observation period and needed approximation of their normalization points. Subjects for further studies include 1. What other sources of uncorrelated liquid and low maintenance income are available, and which are the best choices? 2. What are the best asset choices for an emergency fund? 3. What are Puerto Rico's sources of tax free interest income? The most important outtakes from the study are that if you are trying to protect your money against drawdowns due to a rate hike cycle, you want to go to cash or short treasuries. If you want to make income, you may consider high yield. Not financial advice. Do your own research.